Alright, so I know that this past month has been an eventful one, and my heart goes out to the people of Ukraine and Russia who are risking their lives for freedom. After living in Europe for much of my life, it is difficult to see this happening because some of the guys that I was playing baseball against were from Ukraine, and now some of them could be risking their lives, and that's just something crazy to think about. But I think it brings up an important point for many of us to realize just how blessed we are in the places that we live today. I confess to you guys that I take a lot of these things for granted, and moving forward, I will be reminded of what I have, and I hope that you do the same. But with all that said, I want to go ahead and dive into the stocks that I could be buying and will be buying in the month of March. So let's go ahead and dive right in. So the first stock I'm going to be buying in the month of March is Cleanspark. Now, I'm not going to spend too much time on this one because if you've been a part of my channel, I've talked about this stock numerous times, so feel free to watch some of those videos to get a full breakdown. But here's some things I want to remind you of as to why I personally am invested in this company and will continue to add. First, the company increased their Q1 revenues by 17-fold, increasing from $2.3 million to $41.2 million. Their Q1 revenues was over 80% of the entire last year revenues. And when we compare it to the previous quarter, revenues increased by $14 million, which is 52% quarter over quarter. They are also projected by analysts to have over $182 million in revenue this year, which honestly, I still think could be kind of low. And as long as Bitcoin continues to steadily increase, I wouldn't be surprised to see the company do over $200 million in revenue. They also had their first profitable quarter with net income reaching $14.5 million and an EPS of 35 cents. Plus, according to analysts, they have this company projected to do $1.50 of EPS this year. That would mean that the company would have a forward PE of around 7. Even in this market, you won't be able to find many growth companies with that kind of valuation. Plus, with Cleanspark having half the number of shares as their competitors, they have an opportunity to either dilute shareholders to raise money for a good acquisition, which Cleanspark has done in the past, or they could continue to grow their EPS. When it comes to dilution, Cleanspark's management team has already said that they aren't planning on using this strategy, especially at these low prices. But if it leads the company to improving hash rate and revenue, I personally wouldn't mind them taking this route, especially when the price is a whole lot higher than it is right now. Now, of course, we want to be able to see that the company can continue to grow their EPS. But so far, I like what I'm seeing from the company. When we look at where the company's at and where they're going to be at the end of the year, I believe Cleanspark is the kind of company that a lot of funds are going to be looking for. They also have more assets than they do their entire market cap, with liabilities at about 6% of the total assets. The only way that this valuation makes sense is if the market believes that the assets will decrease over time. The company is also debt-free, which is nice to see, but the company did say that they will use debt in order to get more miners. This will once again improve their hash rate in the short term, leading to more Bitcoin generated. Plus, with Cleanspark demonstrating some of the lowest energy costs to mine a Bitcoin, we could see some tremendous profits in the short term. Another thing to consider is that Cleanspark is extremely unique when it comes to how they use their Bitcoin. They're actually selling their Bitcoin in order to get more miners. And this will have a huge impact on the years to come, as long as you believe Bitcoin will be priced higher years from now. Lastly, this company seems like they're the most confident that they've ever been, especially when it comes to their vision and execution. And when we look at where this company is going over the next 3 years, I see significant opportunity for major gains. Now, of course, a lot of this is going to be dependent on Bitcoin prices. But as long as you're bullish on Bitcoin, I believe this could be one of the best performing Bitcoin mining companies. So right now, my Cleanspark position has already been built out, but I will continue to add as long as it is under $12 a share, which honestly, I don't think is going to last much longer. But if it does, then I'll certainly keep buying. The second stock that I will be buying in the month of March is Palantir. For those of you that have been watching my channel, you had to assume that this was going to be on here. Now, if you are looking for a stock that you're willing to hold for less than a year, this company is not for you. But in under 3 minutes, I want to try to give part of my bullish thesis and share why I think this company is undervalued. First, the company has an extremely sticky business model, and this goes for both their commercial product and their government product. For the commercial side, we are in a time where interest rates will continue to go up, and I believe that inflation is going to continue to be high in 2022. So we could see a lot of companies looking for the best way to optimize cash and run their business in the most efficient way possible because margins could drop. And this is the time I believe that Palantir can capitalize on their business. We have already seen companies demonstrate how the Palantir product has improved their business. And with all these fears going on, I wouldn't doubt this year to be an outstanding year for the company. Looking at their past earnings report, there were many people, including Cathie Wood, that were very upset with the decrease in the government revenue growth. But I think they looked way too close at the numbers and not at the full picture. Because here's what we got. When we look at the world that we live in today, where there are wars and rumors of wars, and now countries are adding more to their government budget, I don't see how Palantir couldn't get any of this market share. I honestly don't see the US decreasing their budget this year. The more the Gotham product is a part of the US government, the more difficult it will be to move away from it. So now there are increased government budgets, and we could see new contracts coming from Europe in the near future for Palantir. I mean, we saw a couple of weeks ago, Alex Karp was in Germany. And with the things going on in Ukraine, many countries are going to want to have the best software to be able to make the smartest decisions in as little time as possible. And that's where Gotham comes in. I wouldn't be surprised to see the government revenue to still be solid this year. But if we're honest, the majority of the total addressable market is not found in the government segment, but it's more so in the commercial business. So even though I think that there's opportunities for the government revenues to continue to grow, I think that would just be the cherry on top. Alex Karp during the earnings call talks about the progression from the US government to the US commercial business to the rest of the world. And I think now we are starting to see all three of them working at the same time. Now analysts have this company doing $2 billion in revenue. And honestly, I think they could beat that number. Their estimate is under guidance of what Alex Karp told the investors. And this company is confident with achieving 30% plus revenue growth over the next 4 years. And especially when you look at what they've done this past year, I believe those numbers are easily attainable. If the company achieves 30% revenue growth over the next 5 years, they would have about $5.75 billion in revenue, which doesn't sound like a lot. But when you consider the margins for Palantir as a software-based company, I believe in the next 5 years, Palantir would be so profitable that they could have $1 billion reaching the bottom line in 2026. Now, I'm sure many people are wondering how the company will be able to increase 30% over the next 5 years. But it all comes back to the total addressable market. In 2025, analysts project their TAM to be somewhere around $200 billion. That would mean the company would have under 5% of the market share. With the confidence of the company, it's hard to see them only get 5% of the market share. Now, the projections I just made are bearish numbers in my opinion. But personally, based off of their sticky product and their growing TAM, I believe that they will be able to easily put 20% on the bottom line by 2026. Palantir is also continuing to build products for smaller businesses. They want to be able to give a smaller product to smaller businesses so they can be introduced to the vast ecosystem. And as these small businesses continue to grow, they will be able to purchase the full Foundry product. So when you think about their business model, it is outstanding. Plus, with the improvements that they're making to their stock-based compensation to normalization with other software companies, we could easily see them profitable between the next 1 to 2 years. My current projections have this company doing $6 billion in revenue and $1.25 billion in net income. Let's say they increase their shares to 2.5 billion shares, which is an enormous increase. The company would have a forward PE of about 23. That would be an extremely low valuation in my opinion, especially when you consider that this is a software company that could be growing revenues 20% or more through 2030. And at that point, the total addressable market would be $360 billion. Personally, I think this company could have between 5 and 10% of the market share by 2030. That would mean that the company would have between 18 and $36 billion in revenue. But like I said, those are my bullish numbers. With Palantir having no debt and $2.3 billion in cash, plus various products that are focused on driving strong business no matter what the environment is, this is not only a company that is going to last, but a company that is built to grow even in hard economic times like what we could be experiencing now. But those are the stocks that I'm for sure buying in the month of March. But now I have 3 stocks I could possibly be buying here in the next month. Now please keep in mind that I've not done my full research on these companies. But if you'd like me to do a deep dive into any of these, feel free to mention that in the comments down below. But the first possible stock that I could be buying this month is PayPal. PayPal has fallen drastically from their highs in the past year, and it looks like an intriguing price. Now, Jeremy from Financial Education has already given some pretty good points, but there are some concerns that I have that I need to get answers to. For many people right now, a big reason why they're getting into this company besides the price is the Venmo partnership with Amazon. Now this could be huge for PayPal, but I'm not sure how the news on Venmo reporting taxes on payments of $600 or more could affect the revenues on this partnership, but also the users on Venmo as a whole. The other question that I have is what allows this company to justify a 60 forward PE? I have to admit that their EPS is outstanding, but with the growth under 20%, it's hard to see this company have PEs as high as it was. But I'm going to need to listen to their conference call in order to see how this could work. And I know I could be missing the opportunity waiting this long. But honestly, right now, I see better opportunity elsewhere. However, when it comes to my portfolio, it would be nice to add a large cap because many of my companies are small to mid caps. But at this point, I'm okay with not owning it. The second stock that I'm going to be looking at to buy here in the month of March is Opendoor. Opendoor is a digital platform for residential real estate. Now, if you look at this past year, this company has gotten absolutely destroyed, going down over 70%. Now, the company has a bad rap because their competitor Zillow lost millions of dollars on this business. And so the question is, if Zillow performed poorly, then what makes Opendoor any different? And how would they be able to do well when prices for real estate could fall over the next couple of years? Both of these are really good questions and ones that I want to be able to explore. But here's what I understand right now. Opendoor does have much more experience in this segment than Zillow does. They currently have over 17,000 homes on their inventory and $1.7 billion in cash. That totals up to over $9 billion in assets. And their current market cap is around $5 billion. So simply just looking at these facts, it looks like a pretty safe investment considering the fact that they're not profitable. Now, if we look at what they did last year, they had revenues over $8 billion while selling over 21,000 homes. So they almost have enough homes to sell an entire year's worth. The only fear would be if the real estate market crashed. But with $1.7 billion in cash, they should be able to cover most of their expenses from these homes for a while. Now, yes, they've burned over $660 million in cash this past year, but that would still leave $1 billion to keep these homes. Now, if we were to look at their annual revenue growth, for transparency, I'm going to need to listen to their conference call in order to see if these numbers are truly valid. So that's probably one I'm going to be looking at this upcoming week. And the last company that I'm going to be looking to buy here in the month of March is The Honest Company. With a child on the way, I'm starting to see and hear more about The Honest Company and their products. But there are a couple of things right now that are stopping me personally from making this one part of my portfolio. The first question is whether or not this company is truly going to be able to gain market share. I know there are a lot of people that have talked about another company called Hello Bello, which has been also growing rapidly. And so I'm going to need to look at their competitors to see if The Honest Company could truly be a number 3 player. And the other question that I have for this company is whether or not they could be profitable in 2023. Now, granted, this is a needs-based business model. So even if there was a recession, more than likely they won't be affected when it comes to their revenues. But if the company doesn't get the margins that they need and are burning cash, then this could be a difficult one to make a move on. They're projected to burn about $35 million. And with only $27 million in cash and cash equivalents, there's a little bit more risk from that perspective. But if I can see this company become profitable in 2023 and they could grow their market share rapidly this year, then I'll consider adding this one to my portfolio. I think it would be a nice add for diversification reasons. But there are some concerns that I have. So this position won't be big like some of my other high conviction plays. But I hope you guys enjoyed this video, and if you did, would you consider tapping that like button? It helps this channel immensely, as well as comment down below your thoughts on the stocks I'm looking to buy here in the month of March. And if you're new here, hit that subscribe button down below. That way you're notified when new content comes out. Hope you guys enjoyed the rest of your week, and we'll see you in the next one.